Welcome everyone to our third Benjamin Capital Investor webinar. My name is Joe Bettag, the CEO of Benjamin Capital and your host today, and thank you for attending. Um, we're going to show our third example in terms of what we're doing here as far as our sales that we've done historically. And let me bring this up real quick. So this was our third case study. This was a completed reverse mortgage bank foreclosure, also known as a HECM REO. HECM stands for Home Equity Conversion Mortgage, and REO stands for Real Estate Owned, which is another banking term for completed foreclosure. This type of mortgage is used by retirees to tap their equity over time to help pay for their monthly living expenses. It's very common to see this type of home having a lot of deferred maintenance. And in many cases, the homeowner passes away, and then the mortgage goes into mortgage default and a foreclosure is completed. This asset was in Hobe Sound, Florida, which is about a 30-minute drive outside of the city of West Palm Beach, Florida. We purchased this REO in September of 2023 from a private equity group for a little over $249,000 and had a little bit over $65,000 in expenses for a total cost basis of roughly $315,000. This private equity group and its affiliated company had paid $273,100 when they purchased this REO, and we purchased this asset $23,800 below the original cost 6 months later. During the due diligence process and before we purchased this REO, this home required a complete interior gut job. So we had to determine our projected cost for completed interior renovation. We determined that the renovations were cost effective, and then we closed on this asset on the purchase. Between the length of time to manage the renovations and then the market time to sell the asset, we had a total holding period of 244 days. We sold the REO in late May of 2024 for $360,000. And as you can see, the holding period was 244 days. Our net profit was close to $45,000. Our return on investment was a little bit over 14%, and our internal rate of return was a little bit over 22%. During our first two case studies, we discussed recently, we spoke about the difference of return on investment versus internal rate of return, also known as IRR. And this is a great example of that difference when you factor in what the internal rate of return measures, which is the annualized return when the length of time is part of the equation. In this case, when no length of time is looked at when using the return on investment, it was at a 14% return. But when actual time in holding that asset, or what I like to call the time value of money, the internal rate of return is at 22%. From an investment perspective, and when you compare this case study to our first two that we went over on earlier videos, and when we hear investors saying that they only care about their return on investments, and they don't pay much attention to the internal rate of returns. This may be the case for a real estate investment that you're holding for the same one for 5 to 7 years. But when you look at our business model, that we're turning over our assets at least 3 to 4 times during a 4-year period of our fund, the internal rate of return is a better way to measure what we do. Here's a great example of making this point. Our second case study recently posted discussed an asset that we held for only 17 days with a return on investment at 20% that treats that outcome based on us holding that asset for an entire year, when in actuality, we only held it for 17 days. And when the time value of money is considered as measured by the internal rate of return, that was at 57%. Now, look again at this current case study. It took 244 days to complete the renovations and market time, and now we can see how time impacts the returns. 14% return on investment and 22% internal rate of return. Let me ask every investor watching this video, what would you prefer? Having your capital involved in an investment strategy that could possibly turn over your capital multiple times in a 1-year period with the type of returns in case study 2 at a 57% internal rate of return each time over 1 year, or an internal rate of return of only 22% over 1 year. That's why we projected 18 to 22% internal rate of return on a passive basis to our investors that's been based on our first two funds since 2014. Wall Street trades the paper. We resolve the assets for better profits. We have managed two NPL REO funds, one from 2014 to 2017, and another one from 2022 to 2024. Many investors look at the fund and this investment class as a hedge against other investment holdings. Others look at buying hard assets at substantial discounts, and others want a 20 to 25% exposure to alternative investments when looking at their total portfolio. 5 years of fiscal and monetary policy with extended pretend is coming to an end. The data we look at indicates we have a perfect storm coming. For those who want to take a deeper dive, we also have a series of white papers created that discuss various aspects of distressed real estate debt regarding how this opportunity has been created and why the timing is right. The white papers can be found at our website at www.benjamincapgroup.com. That's CAPgroup.com. If anyone wants to learn more about how we make money on our website, once again, our website, www.benjamincapgroup.com, CAPgroup.com. You can also follow us on LinkedIn, Instagram, Facebook, Substack, and our YouTube channel. Look for Benjamin Capital Group on all social media. Thanks for attending, and we hope this was informative to everyone. Thank you.